Welcome to Yahoo Finance Live. I'm Emily McCormick, in today for Shauna Smith, here with Adam Shapiro. We are minutes away from the closing bell this Monday afternoon, and with us now to help make sense of today's market action are Wylie, Tollette, Franklin Templeton, Executive Vice President of Client Portfolio Solutions, and Rebecca Walser, Walser Wealth Management President. And Wylie, I'll turn this first question over to you. We're seeing really strong moves to the upside this afternoon in markets. Is this all about second quarter earnings optimism, or what do you think is driving this?
Yes, I really think that's driving the markets this week. I think people are expecting pretty astonishing comparables versus last year at this time. I think consensus is something like 64% earnings growth for the second quarter of 2021 when you compare it to the second quarter of 2020. And it's hard to be pessimistic in that type of environment with those type of comparables. So I think we're starting to see that float through the equity markets. Longer term, of course, there's we're going to see stimulus packages start to look a little bit less favorable in terms of comparables looking forward. But in the short term, I think this week is going to bode well, particularly with banks. I think we're going to see bank earnings come through nicely this just a little bit later this week.
Of course, and Wylie and Rebecca, we're going to have you on hold for just a moment, get one final look at the market heading into this final minute of trading. We are having the S&P 500, Dow, and Nasdaq pacing toward record closing highs. We're taking a look at the sector action here with the financials, real estate, and communication services sectors in the S&P 500, each leading to the upside. We only have energy and consumer staples in the red this afternoon. And then taking a look at the Treasury market, we do have the 10-year Treasury moving up by just over 1 basis point. Here's the data.
All right, we got a closing bell. He looks excited about it. Give us the gavel so we can get the final numbers, and we're going to show you where we settle in this market because we got a bunch of earnings to get to tomorrow. The Dow is going to settle up about 130 points. S&P 500 up about 15 points. Nasdaq settle up about 31 points. Some of the big gainers on the Dow today, by the way, talk about Black Widow, take no prisoners. $80 million at the box office, just in theaters. We're going to deal with that with the IMAX CEO in just a second. Goldman Sachs reporting tomorrow. They were up 2.5%. JP Morgan Chase up 1.5%. They're also reporting tomorrow. But let's get back to the guests. And it's good to see you again, Rebecca. So I got to ask you, are we seeing the kind of volume in the markets right now that would indicate that this is not only a genuine drive up, but that there's further growth upward?
I mean, it's hard to say because we've grown so much. I mean, I like to look at the S&P as the overall 500 benchmark, and we look at March 23rd, which was its low, 22.37, and the end of last month it ended at 42.97. So that is literally over 2,000 points it gained in the last 15 months. A lot of it, Adam, as you know, is a lot of the stimulus money. We had 3 legislative acts, CARES, HEROES, and ARP. And then we had the Federal Reserve stimulating, and we know they're still buying $120 billion a month. So a lot of it is stimulus. A lot of it has made its way in. Do I think we deserve to have that much of a return on the market based on the fact that we've been shut down? No. But now it's all about, and I think this is we're going to be looking at for Q2, is not so much about reopening, but really what are the actual results growth year over year. And obviously, if we look at quarter 2 last year, we are expecting consensus is 64% growth year over year, but 64% off of basically being shut down, is we should be seeing a huge number from that. I was just hoping the Dow was going to close at 35,000, so I'm glad that it did make it. It was just under right before the bell ended, so I was glad that it made it. I was sitting here cheering for it. I was like, yay. I mean, I'm overall optimistic for the year, but I do expect that we are going to have some bumps in the road. It's not going to be all smooth sailing because we do have to wean ourselves off of some government QE and get back to normal.
And of course, we do want to throw things over to Yahoo Finance's own Jared Blickry for one final look at the market. Looks like we did make it to those record closing highs, Jared.
That's right, and it's not just the S&P 500, the Nasdaq, and the Dow. It's the S&P 500 equal weight. That's important because that indicates that there's some breadth back in the market. Now, you still need the Russell 2000 to come to the party, but guess what? Earnings season is here. And it's been about 6 weeks of very little news, company-specific news, but that excuse is over right now. We've seen the Nasdaq drift higher over that time. Value stocks take a little bit of a hit, and now it's incumbent upon these earnings moves to fuel that further rise up.
All right. Thank you so much, Jared. And Wylie, I want to ask another question. We've been talking a lot about equities, but what about the bond market? And of course, we do have the 10-year Treasury yield off of those 5-month lows from last week. We had another guest talking about a little bit of a disconnect between economic expectations and where the 10-year is trading now. Where do you expect things to shape up for yields in the next couple of months?
Yeah, it's a great question. It's definitely been one of the most surprising elements of the markets this year. Frankly, earlier in the year, we're multi-asset class investors, and so we have to keep our eyes on a variety of asset classes, including government bonds, which are a very, very typical component of many multi-asset class portfolios. And we have our internal analyst team looking at the 10-year yield. And earlier this year, we did expect yields to tick up. And one of the biggest surprises, as I mentioned, is they have not. In fact, last week we saw them ticking down in 1.25. I think we're at 1.3, 1.35, right in that neighborhood. We frankly see equities still as a better place to be relative to fixed income over the next 12 months. Basically, we kind of view fixed income right now with a bit of an asymmetric risk, where the possibility that yields will tick higher and reduce prices, cause negative returns. We think that's a bit of an asymmetric risk relative to what you're getting compensated for in investing in the 10-year. Should it still be part of your portfolio? Absolutely. But perhaps right now, fade it a bit underweight. We do expect yields to continue to tick up, but we've moderated those expectations quite a bit, where perhaps somewhere in the 1 3/4 range for the rest of the year.
Just want to follow up real quick with you on something regarding equities. Are there sectors that you favor, and should we as investors be a little bit concerned by the fact that the one sector down today was consumer staples?
Well, I mean, I don't know what word to use for this really fast. It's not the sexiest sector. And certainly when people think that they're going to have a great earnings season, they'll cycle out and want to take their chance on some really good numbers on some more faster moving sectors like financials. So obviously with the financials looking to be really good on this earnings season, I just don't think that people are really wanting to stay at the basic, the consumer staples. And that makes a lot of sense for where we are right now in this season. But I do think that there is a place for every sector. I do take his point that it's all equal weighted S&P 500 up. That does really bode well for us. We need really strong breadth. We don't need just tech sector like we had it carry us last year. So it's exciting to see that it's going to be across the board. And I would say that consumer staples will definitely be a winner at some point in this year when people start to see that maybe there'll be some pullbacks along the way.
And Wylie, definitely want to get your take on that question as well. Where do you think we're headed on that front?
Yeah, in general, we think this rally that we've seen in value that really accelerated sort of the last part of 2020 into the spring, and then it took a bit of a breather again as rates fell and people thought basically started to look through some of that, and we saw growth names reaccelerate through May and part of June. We actually think there's more room to move in sort of traditional value names, including consumer staples, energy, materials, financials. I think we'll start to see that a bit this week, again, with bank earnings coming out and Alcoa, right around the corner after that. We think we're going to see some pretty amazing earnings numbers, and we think there's more room to run in that space. So we're still bullish on value versus growth.
Let's head back to Jared Blickery. He's at NICE. I want to ask him about what's happening with Bitcoin. It's trading down right now.
Yeah, we keep talking about 30 to 32,000 as an important level, but let me just back up a minute and explore what's going on. We just had a halvening last year of Bitcoin. That reduces supply. Weak hands, the weak miners are forced out. But also, we almost had another halvening, and that was because China has cracked down on Bitcoin miners. So the weak hands are being flushed out, which is good long term. But this point was made to me by Yves Lamoureux. I call him the Canadian whale because he's one of the best Bitcoin timers I've found, and he's honed in on this situation. We might need a market clearing event. It's possible 30,000 holds that we can build and rise from here, but the other solution to the problem is a market clearing event that comes down to 20,000 or maybe even 13,000. So hopefully the current levels hold and we can base and rise from here, but it's not a guarantee.
Rebecca, you've said that crypto is going nowhere. What do you mean by that? What do you tell your clients who say, look, this is an asset class I want to be in?
No, what I mean that it's not going anywhere is it's here to stay. We have to deal with it. It's not going anywhere. We're going to deal with it. And I have to take issue with some of the federal government coming out and saying that they retrieved, stuff that was in a Bitcoin wallet because, I deal with some experts at the high level, and no one can really figure out how they reverse engineered and did that. So I'd like to get some more data sets and facts on that. With China starting to really go down its own path of digital currency, and of course, them being a completely different type of government than we have in America, that is obviously what has happened with the Bitcoin miners being kicked out of China. They're really going down the road of a digital national currency, and they want that to be under their purview and under their control. The Federal Reserve hasn't gone anywhere near that topic, and I think that is right. But I do see a lot of tightening under this administration. In the last 3 months, we've seen a lot of tightening around cryptocurrency, with this administration saying they could require LCTRs, large currency transaction reports, with the IRS coming out and saying they could actually confiscate cryptocurrency. So we're starting to see this administration really starting to speak up around crypto. And so we should expect more government involvement and interference. But I don't think that blockchain technology, and specifically cryptocurrency, is going anywhere anytime soon. And I think long-term clients should have a portion of it in their portfolio. Absolutely.
All right. Well, thank you so much, Wylie Tollette, Franklin Templeton, Executive Vice President of Client Portfolio Solutions, and Rebecca Walser, Walser Wealth Management President.